In today's video, we're going to talk about how to grow a small trading account fast. When I first started trading 5 years ago, I blew numerous small accounts taking random trades. It wasn't until I developed a proven edge and system that I was able to grow a small trading account from 3,000 to 57,000 in 2 months. The framework that I'm about to lay out in today's video is exactly what I would use if I were to grow a small account today. So without further ado, let's get right into the video. All right, guys, in today's video, we're going to talk about how to grow a small account. Growing a small account as a beginner can be quite challenging. I've personally grown many small accounts. I've personally failed many small accounts. And what's so good about growing a small account is that you only need to grow a small account once. Once you grow a small account into a large sum of money, you won't need to trade with the limitations of what a small account has. So in today's video, I'm going to talk about how I personally grew a small account from 3 to 50K in about 57 days. I'm going to talk about the expectations, my risk management, my strategy, everything that you need to know about how to grow a small account when it comes to trading. So with that being said, let's get into the first aspect when it comes to growing a small account. So first thing that we have here is two different expectations when it comes to growing a small account. Number one, on the left-hand side, what we have here is exponential growth. Whenever you're trading a small account, the mindset of a lot of traders is that they'll look for exponential growth. They plug in this compound calculator and they expect the results to double, triple, quadruple within a very short period. And what you have to understand is that growing a small account is very possible, but there are a bunch of things that I'm going to talk about in this video. And number one being expectations. If you come into the markets, you've never traded before, you don't have a system, you don't have a strategy, you don't have an edge, how do you expect yourself to grow a big account if you can't grow a small account? So what we have here on the left-hand side is the power of exponential growth and what can happen if you do have the right strategy, right systems, and right risk in place. On the right-hand side, we actually have here is the opposite of exponential growth, which is the percent recovery. And the compounding effect actually goes both ways, towards the upside along with the downside here as well. So if we're losing money in the markets, you can see if we lose 50% of our account, for example, it would take us 100% to get back to break even. If we lose 70%, it would take us 233% to get back to break even. And if we lose 90% of our account or 95% of our account, it's going to take us over 1900% to get back to break even. So it's good that we want to keep our expectations in line. We don't want to get too ahead of ourselves here. So now let's talk about my risk management system when it comes to growing a small account. Okay, so now we're going to talk about risk management when it comes to growing a small account. And for me, it's broken up into 5 steps. Number one being trading capital. We're going to talk about how much capital that we should start off with. Next, what we have is risk per trade. It's important to understand how much risk we should allocate to each potential trade. A risk to reward ratio when it comes to trading. We're going to talk about the win rate, which is important in combination with the risk to reward. And then finally, what I have here is a bonus, which is your max drawdown. So let's first talk about trading capital when it comes to trading. So the one question that I always get asked, how much money should you trade with when I first start trading? And the one answer that I can give with 100% certainty every single time is money that you can afford to lose. The reason why I say this is because when you trade, what you're doing is putting on risk. Every single trade that you take, you're putting on risk in the markets. And there's a difference between putting on risk and accepting risk. Accepting risk is what's important because you're letting the probabilities play out. A lot of traders, what they'll do is put on a trade, but as soon as they put on a trade, they'll second guess themselves, questioning if they really want to be in this trade, if there's thoughts lingering in the back of their mind, thinking about the money that they could use instead, maybe to pay bills, maybe to pay rent. This is going to affect them psychologically, where they might actually cut the trade before the trade either hits your stop or your target, just due to the fact that you're not accepting the risk. So when you first start out trading, you have to learn about putting on risk and also accepting risk as well. And the money that you can afford to lose, right? You're expecting to lose that money. So if you're expecting to lose the money, that means you can actually let the probabilities play out. You're more focused on the process. And then in turn, you actually end up making more money if you're focused in on the process in itself. So hopefully that makes sense. But now let's go back onto trading capital and how much money we should start trading out with. So right here, what we have is the dollar amount, how much money we should have, and what asset classes we should trade depending on how much capital we have. So there's the scenario where I have underneath $1,000. If you have underneath $1,000, what I would recommend is primarily paper trading along with backtesting. In this case, you don't have too much money to trade with. It's very hard to trade with an account underneath $1,000. There's a lot of restrictions. You don't have too much margin to play with. A lot of brokers don't offer margin underneath $1,000. Your best bet is to build up your capital outside of trading, and you want to paper trade along with backtest. There also is a new route that you can take here as well, which is prop firms. They've recently became fairly popular in the past few years. I know plenty of traders myself that have taken a very small amount of money into a large sum of capital, but that is done only when they had a proven edge in a proven system. Now let's talk about in between $1,000 and $10,000. In this price range, you're going to have a plethora of options to choose from. Number one, you can trade stocks with about $1,000 to $10,000 account size. You can trade penny stocks, you can trade mid caps, you can potentially even trade large caps. It is going to be a little bit more difficult, but that's why we have number two, which is options. Options in this case where you can trade ETF, you can trade SPY, the Qs, the tech names. You also can trade futures here as well. So a lot of brokers offer futures. Depending on the broker, they offer nice margins here as well. So you can trade futures, you can trade the micro contracts. I would stay away from the mini contracts. And they also have Forex here. I personally don't trade Forex, but you can trade Forex if that's your preferred asset class. And then we have the greater than $10,000 option. So when we're first starting out trading, in my personal opinion, we do not need this much to trade with. So if you're trading with over a $10,000 account and you're a beginner trader, you're probably trading with too much money. The great thing, if you're watching this video and you don't have any money, is that you're actually in a really good position. If you lose less than $1,000, it's not going to be the end of the world. If you lose over $10,000, that might be your life savings. That might take you a while to save up. But if you don't have that much money, you're actually in a really good spot because you're going to actually focus in on building the process first and then worrying about the capital later. So now with this out of the way, let's talk about how much we should risk per trade. So when we're talking about risk per trade, a good rule of thumb is that you should risk no more than 1% of your total account size. This is if you have a little bit of a larger account here and we're strictly basing off percentages. Of course, if you're risking 1% on a very small account, you're not going to make that much money. But we'll talk about some things that you can do once you develop an edge in this case. So if you scroll down here, for example, if you have a $1,000 account and we risk about 1% here, that's only going to be $10. Strictly speaking off percentages, but if we have a bigger account, you can see a $25,000 account. Now we're going to be risking around 250 bucks. And if we have a $100,000 account, that means we're risking $1,000 per trade. So the percentages in this case are the exact same. They're all 1%, but the actual dollar amount is going to be different based on your account size. So what we want to be focusing on here is the percentage amount, which is 1%. But of course, if we are trading with 1% on a $1,000 account, it's going to take a while in order to grow the small account. So for example, here, if 1R equals $10 and we want to double the account, it's going to take us over 100R in order to achieve $1,000 profit, which in this case would be a 2x on our $1,000 account. This would mean that in order to get 100R, for example, at a 1 to 2R multiple, it would take us over 50 trades in order to achieve a 2x on the account. 50 trades on a small account with a 1 to 2 risk to reward ratio is going to be a good enough sample size to know that if we're disciplined enough in order to grow a small account. What I always say is that if you can't grow a small account, what makes you think that you can grow a large account? So when growing a small account, you want to risk the least amount possible because you are in the learning phase. And once you're able to develop an edge, I say this very carefully, Once you're able to see consistency, that's where you can look to gradually increase your risk amount. So instead of risking $10 for 1R multiple, you could potentially increase your risk to $20 for a 1R multiple. In this case, your risk amount is still 1R, but you're just changing the dollar value. As I just mentioned, it is very important that you start off small and then gradually increase your risk. You should only be increasing your risk once you see consistency in the markets month over month. I know it's not flashy, but all you have to do is grow a small account once. So now let's talk about risk to reward and win rate when it comes to trading. Next, we have risk to reward and win rate. A misconception that we have is just because you have a high win rate does not mean you're successful when it comes to trading. So right here, you can see I have the risk to reward and win rate cheat sheet. And where I personally lie when it comes to trading is around a 40% win rate with a 1 to 2. And I lie in this area right here. This is me on an average month. If the month is regular, market conditions are a little bit slower, I'll have closer to a 40% win rate. If we have hot market conditions, I'll lie anywhere between 50 to 60% with a 1 to 2, and I'll be really profitable if the market conditions are hotter. So as you can see right here, you can have a 40% win rate in trading and still be a profitable trader. And the reason why this is the case is because of your risk to reward. So risk to reward is understanding how much dollar amount you're risking for every trade that you're making. So in this case, if it's a 1-to-1 risk to reward, that means you're risking, for example, $100. If $100 is your R multiple, you're risking $100 to make $100. If we have a 1 to 2 in this case, that means you're risking $100 to make $200. And then a 1 to 3, risking $100 to make $300. So if we're looking at this risk to reward ratio chart, of course, we would like to aim for a higher risk to reward ratio. But based off our previous chart, we can see that generally speaking, if we have a higher risk to reward ratio, we're gonna have a lower win rate. If we have a higher win rate, we're gonna have a lower risk to reward. And what a lot of people don't get about risk to reward, especially when it comes to trading options, is that it's not gonna be fixed. So if I trade futures, my reward and my risk is going to be fixed. So that means for every single point, it is going to be fixed. So let's say, for example, I trade the mini contracts on the ES. If I trade the mini contracts on the ES, every single 1 point is going to move $50. It does not matter how long it takes, how fast, 1 point is 1 point. And that is going to be consistent. So that's why in this case, your R multiple, you can easily calculate it and base it just off a dollar amount. Whereas if you're trading options, which is what I personally trade, your R multiple is not going to be fixed. Your R multiple can change depending on a lot of factors. What's affecting the option contracts are a bunch of things in regards to the Greeks: theta, delta, IV, how close to expiration we are. So there's a bunch of things that are affecting the actual options price. I'll talk about some examples of how to calculate here in a second. When we're trading options, over the long period of time, we're aiming for that 1 to 2 risk to reward ratio, but sometimes we're gonna have a break-even trade. It might be a 0.5 hour trade. We might have some nice trend days, and we can have a 1 to 5 or potential 1 to 10 risk to reward ratio. If you guys do want a more in-depth video on how I personally trade options, what strike prices I choose, how to calculate risk, let me know in the comments below, and I could potentially make a more in-depth options tutorial. All right, so we're here on my example here. This is a trade that I ended up taking here on NVDA on June the 6th. And as you can see here, the levels that I have coming into NVIDIA is your previous day highs. So we had our previous day highs marked out. What I was looking for was really your previous day high retest. And when I was looking to trade NVIDIA, I was looking for this previous day highs level to hold. If we can hold and retest your previous day highs, which we ended up doing right here, close to our 940, we ended up having a really strong reaction off this level, and we had a nice pushback towards the upside. Once we had this confirmation candle that price was most likely going to reverse back towards the upside, this is when I ended up taking a position. So on the underlying, I was taking an entry close to your 138 level. Risk was our 138.12, and then my reward was our 140 along with our 141 and above. So as you can see, I was risking roughly around 50 cents to make over $2.50. This would be roughly a 1 to 5 without taking any partials. So if we scroll down here, I'll show you exactly my executions and how I calculated risk based off of this chart. So as you can see, this is my TradeZella stats. And what I want to show here is the actual risk amount, which is important. So as you can see right here, I risked around 1.7 on the actual options contract. In this case, I had an entry close to 1.9 on the contracts. So what I was basing my risk off of was the actual underlying the previous day highs. So a lot of my entries, I only need to give price 10 to 20% on the actual options contract. So if I have a $10,000 position, which in this case, I had roughly a $10,000 position, I only need to give it around 10 to 20% to know if my trade is going to work out. So if I'm risking 20 cents in this case, I'm risking around 10%. So that's where I get my R multiple, which is around $1,100. It's not exactly $1,000, but you can see on average, it's going to be around $1,000. And I want to risk on average 10 to 20%. In this case, for NVIDIA, $9,000 position size, 1.7 on the stop. So as NVIDIA pushed back towards the upside here, my realized R multiple ended up being close to a 5R on this trade. Of course, I always look to practice scaling. What's great about options is that you can scale your position and then you can leave trailers. Trailers is what's always going to make you a lot of money, especially when it comes to trading options. And the reason why you can hold trailers in the first place is because you locked in some profits. I'll talk a little bit more about my management approach when I go over this live example at the end of the video. Now let's go on to my final risk management tool. And my final risk management tool is what I call the max drawdowns. Essentially what a max drawdown is the max amount of money that you're willing to lose at any given time. When you first start trading, a lot of the times you're not going to know what you're doing. So what you want to protect and what's most important is capital. Capital being your buying power. This is one thing that you always want to protect. This can be a daily max drawdown, a weekly max drawdown, or a total account size drawdown. And you want to have this in place so at times where there is the anomaly where you either go on tilt or some things happen, right, where you over leverage, you want to protect yourself so you don't blow up your entire account in one day or maybe in 1 week or in 1 month. And the way to calculate your max drawdown is by simply figuring out how much you're willing to lose on any given time. For me personally, my max drawdown is anywhere between 5 to 10% on a total account size. So for example, if we have a $20,000 account and I'm not willing to risk more than 10% on a given day, my max drawdown in this case is going to be $2,500. I'm only willing to risk $2,500, and this is very important. If the broker does allow this, make sure you're enabling this feature. I know a lot of brokers don't allow this because the brokers actually make money from you losing through commissions, through you over trading, for you over leveraging. They actually want you to do that. So that's why most of them do not have this option. So with this being out of the way, let's talk about my strategy when it comes to growing a small account. So my strategy slash system when it comes to growing a small account is broken up into 3 different steps. Number 1, strategy within my system. Step number 2, setups that are within the system. And number 3, rules that I abide by no matter what, given the exception. So let's go on to number 1, the strategy that I personally trade. So when it comes to the markets, currently I just have a blank slate, as you can see right here. The strategy and system that I use is fairly simple. We're gonna go into more setups here that explain this a little bit more in depth, but all I'm looking for is a clear uptrend in the markets. So we have one scenario where we have a clear uptrend, and we have another scenario where we're in a downtrend. So these are some of the scenarios that we look for. The best is when we are in trending markets. So what I'm looking for is a clear higher lows in the market, and you can see level of resistance. I like to see this level turn into now support for this continuation back towards the upside. My risk in this case is going to be a break underneath, and I'm looking for this continuation back towards the upside. Similar thing to the downside, I'm looking for, in this case now, lower highs to be built, clear downtrend, clear support, turn into resistance, using this level as now risk for continuation towards the downside. Of course, this is just the very basics of how the break and retest works. There's other conditions where the markets can be in consolidation, but generally speaking, if we have a clear uptrend, this is what the uptrend will look like on the higher time frames. If we're in a downtrend, this is what it'll look like. Let's go on to some of the setups that I look for intraday. So now we're on the setups. So 3 setups that I look for when trading the markets. Number 1, what I have is the opening range break and retest. This is one of my personal favorites. We've talked about the 1-minute opening range, the 5-minute, the 15-minute. A lot of people ask me, what opening range should I use? Why do you have so many opening ranges? Right? The opening ranges depend on the context of the overall market. I outlined the 1-minute range, the 5-minute range, the 15-minute range. They're all the exact same thing. They're all the opening range breaks. But which one should we use? It is dependent on the market context. If the market is bullish, we're very volatile, we have an opening play, we can be using the 1 and 5-minute opening range. Whereas if the markets are less volatile, we should stay away from the first 15 to 30 minutes. Then we want to be using the 15-minute opening range just because there's nothing going on within the market open and we want to avoid the chop. So we want to stick to the 15-minute. This is what we've been using lately just because the overall markets have been less volatile during market open. Most of us already know what the opening range break and retest is, but I'll explain it here one more time just in case. All we're looking for is the first candle of New York session. We want to mark out the candle. If we are bullish, break and retest for continuation towards the upside. If we're bearish, break underneath the opening range candle, retest, and continuation lower. Now let's go on to the second setup that we have. The second setup that we have is your previous day highs and low. This is something you'll see me mark out every single day in the morning. So if you guys join my pre-market preps, I go over exactly what I'm looking for every single day. You can watch for free every single day on my YouTube channel. But what we want to do is mark out your previous day highs and your previous day lows. What we want to see is a reaction that we have off your previous day highs along with your previous day lows. There's a lot of liquidity resting above and below these levels. If we can break above, we can see continuation towards the upside. If we go to the bottom of the range, we can bounce off your previous day lows and continue higher. If we're more short bias, what we can be looking for is the rejection off your previous day highs for a push down, or now be the break underneath for continuation towards the downside. If you guys want more in-depth strategies on exactly how I trade each setup individually, you can go to my YouTube channel. I have a bunch of videos talking about your previous day highs, opening range breaks, along with order blocks, which is my last setup that I like to use on a day-to-day basis. So the last setup I have here is our order block. And essentially what order blocks are is using up close and down close candles in a trend to support price to the upside or the downside. So in this case, we have a downtrend, we have an up close candle. Up close candles will now be used as resistance for pushes towards the downside. And similar thing to the upside, if we do have a clear bullish trend and now we form a down close candle, this down close candle acts as sellers. So if we can get above this down close candle, now we like to use this level as support for continuation back towards the upside. And these are setups that I use every single day. As I mentioned, if you do want to find more information, I have plenty of videos on each individual setup. So now with this being said, let's go over some of the rules that I have when trading my system. The rules that I have when trading my system. Number 1, money management. Money management is fairly similar to risk management, but in this case, we're more focused on actually how we manage our trades. So when we're talking about money management, what we always have to have, no matter what strategy we trade, no matter what asset class we trade, we always want to have a stop or a point of invalidation. A stop can be a mental stop. It can be a hard stop, depending on which asset class you trade. And then for a point of invalidation, similar thing to a stop loss, it's where you're wrong on a trade. Where are we going to cut the trade if price goes to X? Number 2, what we do is have to think in terms of risk. So whenever we're trading in the markets, we always have to think in terms of risk, which is our multiple. How much are we risking on a given trade depending on the setup? We don't think in terms of reward, we think in terms of risk because that is the only thing we can control. 2, only need to risk max 10 to 20% on our positions when trading options. So of course, this doesn't apply if you don't trade options, but if you do trade options, max is 10 to 20%. If you're risking more than 10 to 20% on an options contract, especially when you're scalping, it's different when you're swing trading because you're going to have to risk more. But specifically when you're trading the break and retest in your day trading, you only need to risk max 10 to 20% to know if your trade thesis is going to be correct. Number 4, scale and lock in profits. This is something I will always preach, locking in profits, especially when it comes to trading options, because when you're trading options, your reward is exponential. Whereas if you're trading futures or trading stocks, it's linear. So you might have a fixed risk reward ratio, but when you're trading options, you can scale along the ways and lock in profits because you never know price is going to gravitate towards your resistance level and reject, or we're going to have continuation and push back towards the upside. No one knows if price is going to reverse at a key level. So you always want to lock in profits and scale along the way. And finally, what I have here on the bottom is talking about how you can always exit a position and look to re-enter. If you get into a position by accident, or maybe you weren't able to manage risk effectively, maybe you got into a spot that you personally don't like, you can always look to exit a position and look to re-enter once you have a more clear picture of what's going on. There's nothing stopping you if you feel uneasy about the trade. So let's hop on to the next portion and talk about some other rules that I have. Other rules that I have is only take trades within the system. This sounds fairly straightforward, which it is, but you'll be surprised. A lot of traders just take random trades because they don't actually understand what their system is and what setups that they're looking for. So for me, I'm primarily taking trades that are within my system. I laid out 3 setups that you can use and that you should focus on: the opening range retest, previous day high low retest, order block retest. These are my top 3 used intraday setups that I look for when trading the break and retest. Of course, we have about 10 to 15 more different setups, but those will have specific criterias. If we're just looking for the basics and we don't want to overcomplicate it, right? These are the 3 setups that we should be taking and we should be looking for on a day-to-day basis. So as for some general rules, what I do have here is a few time-based rules along with some trading rules here as well. I want to mention that rules are rules for a reason. There is an exception to the rules depending on the market conditions, so they're not always going to be exact. Sometimes you have to readjust your rules based off of your statistics. A rule that I abide by is trade for the first 2 hours of market open in between 9:30 a.m. and 11 a.m. Eastern Standard Time every single day. The reason being is because there's the most volatility that happens during the New York session open. And what the important thing here is volatility. So if the volatility is within the 9:30 to 11, that's when we want to be looking to trade. If the volatility is within later into the session, currently for the past month, a lot of the volatility has been later into the day, during noon and in the power hour. So if we're looking to readjust this rule, then we can look for more opportunities potentially later into the session. As I mentioned, the rules are there for a reason. There are exceptions to the rule because the markets are always changing and we need to be adapting. Next, max 3 trades per day. When you first start out trading, you technically should be taking as many trades as possible to gain experience. But if you already have experience, generally speaking, you'll only see a max amount of trades being 1 to 3 trades a day. Of course, as I mentioned, there's exceptions to the rule. If the markets are more volatile, you can look to 3 to 5 trades a day, but really no more than 5 trades you should be taking on a day-to-day basis. So with this being said, I just laid out a general overview of my system, my rules, the setups that I look for, along with my risk management approach. So now let's go on to the charts to see some examples that I took in real time. All right, so we're on my first example here. We're on Tesla towards the downside. As you can see, we're on the 15-minute time frame. We're underneath our previous day lows here, so we are fairly bearish here in the pre-market. What we'd like to see is now maintain underneath your previous day lows for continuation towards the downside here on this name. So now let's play the tape coming into market open. So as you can see here on Tesla, we tried pushing towards the upside, failed to gravitate back up and towards your previous day lows, immediate rejection right off the bat. Now we're gravitating lower underneath your pre-market lows. You can now see we're underneath our 5-minute range low here as well. If you look at the trade checklist, you can see all these ones right here are checked off. If you go back onto the 1-minute chart, now what I'd really like to see is the retest of your 5-minute range low. The reason being in this case is because we already had such a big push lower. The 15-minute range low is a potential area of interest here as well, but most likely the best risk reward is going to come back up and towards your 5-minute range low. So this is the area that we like to look for. We can also mark this out here as well, and we can drag this over. So now let's play out the tape. So we're back into your 5-minute range low. Let's see if there's any sort of reaction here. As you can see right there on Tesla, we end up pushing back in towards your 5-minute range low. You can see we have a nice little reaction here as well. This is where we can go look short with a stop just to break above. Now what we can look to target is low of day and below. Now let's play out the tape. So you can see right there here on Tesla, we ended up getting stopped out, but you can see our risk to reward in this case was very tight. We're risking about 1 point here for a potential move down in towards low of day, which would have been 3 points here on Tesla. We're not looking to hold on to our position, hoping that it gravitates back towards the downside. We end up stopping out where we were supposed to. Now let's keep playing out the tape to see if it will set back up. All right, so you can see so far here on Tesla, we're still bearish just because we're underneath our previous day lows. We're so far getting back underneath this 5 minute range low here as well. So let's go back onto lower time frames to see if there's any sort of potential entry on the 84% rule. So on the 1 minute time frame here, you can actually see we're closing back underneath this 5 minute range low. So if we do want to look for another short position here, we can look for the 84% rule, exact same entry with their exact same stop. And now we can look for the similar thesis as before, continuation towards low of day here and below. So now let's put our stop just a break above. Now let's target low of day. And you can see right there, Tesla ended up having a nice push back down towards low of day. And this one ended up having continuation lower here with the 84% roll. And this is a great example of having a very tight stop. In this case, we had to be very patient, waiting for a setup all the way later into the day. But our first original trade thesis was super solid. 5 minute opening range retest, not quite hit our low of day target. But as you can see, we're risking a very small amount. We're risking 1R to make over 3R. So that means on our first loss, we end up taking a 1R loser. And then on our second trade, we end up making over 3R, which in turn put us plus 2R for the day. Now let's go on to the next example that I have. Okay, so our next example we have in this case is on NVDA. You can see we end up driving towards the upside here in the pre-market. We're above our previous day highs being our 138.12. So now with it being above our previous day highs, what we like to see is the retest of our previous day highs for this continued push back towards the upside here on NVIDIA. Now let's go on to the lower time frames. So as you can see right here, we have our first 5 minutes established. This is also our 5 minute range low along with our previous day highs. So what we like to see is a hold of this level for this continued push back towards the upside here on NVIDIA. Let's keep playing with the tape. You can see that buyers are stepping in right off your previous day lows. Let's see if we can get that confirmation candle that we want to push back higher. Right there, as you can see, very bullish confirmation on NVIDIA, closing back above its previous candle, along with this hammer stick candle here as well. This is where I personally went in long with a stop at low of day. And I was looking for, in this case, right, high of day plus continuation towards the upside here as well. If we look at targets, we can go back onto the 15-minute time frame. Key levels that I have marked out on NVIDIA was back up in towards our 139.60s. So this is a level we can have marked out. And now let's play out the tape. And as you can see right there on NVIDIA, we end up gravitating towards the upside towards our 139. I end up scaling along the ways up in towards the 141 here as well. I'll talk about my scaling process in this live session here in a second, but I ended up being able to take this all the way up and towards that 141. A lot of my trailers end up paying nicely. Contracts end up moving over $2 a con. So this was a great example of risking a very minimal amount. My risk, I was risking around 50 cents on the underlying, which ended up being around 20 cents on the 139 calls. And I end up capturing on my final scales over $2 per contract while I was only risking 20 cents. Of course, not every single contract I made was a $2 profit per contract. That's why we look to scale. So with this being said, let's go on to the live session that I have for this day.
As for a few other names that I do like, NVIDIA, this one reclaimed above our 137. Now what I like to see is the hold above your previous day highs for a continued push back up and towards your 139. So we'll keep an eye out on NVIDIA 137.90.
So as you can see for NVIDIA, what I have coming into today, we're above our previous day highs so far. I'd like to see a hold of your previous day highs for a push up in towards this 139 here on the higher time frames. So this is one of my watches coming into today based off of the pre-market. Now let's play out the tape.
All right, NVIDIA is coming down towards your previous day highs. So far, some buyers stepping in here on NVIDIA.
So right here for NVIDIA, you can see opening drive back towards the downside right now. We're currently retesting its previous day high along with this 137.90s. Now I'd like to see if the buyers do want to step in on this name.
What I would be interested on NVIDIA would be the one, and keep an eye out on the 139s on NVIDIA.
So right here, I'm looking at the 139 calls.
See how this candle closes? You can see NVIDIA so far buyers are stepping in. Let's see if the Qs can reclaim this. Our risk would just be a break back above this 138. Yeah, some of the NVIDIA's the 139s. Risk is going to be a break underneath this 138 here. I'd like to see the Qs also reclaim back above its previous day highs.
So as you can see right there, end up taking some of the 139 calls. Risk is a break below this 138. Very tight risk in this case. Looking for a push back up here with the QQQ and for NVIDIA to gravitate towards high of day and above.
SPY holding your previous day high so far. Let's see if we can get that push up on the QQQ. NVIDIA approaching previous day, a high day, 5-minute opening range high here as well. So yeah, Q should hit high day here, right? Just building structure still. Higher lows are still intact. NVIDIA is one of the main leaders along with AMD, AVGO.
So as you can see, NVIDIA fairly bullish. We're breaking above high of day. Next level is our 139.70s. You can see the markets currently are forming a flat top. So the markets have not broken above high of day, but NVIDIA has. So this is the clear leader towards the upside. We do expect most targets to get hit here with its relative strength. The way I managed my position, right, sold some up in towards your 139. Next levels was that 139.80s. And now I'm leaving the rest of my trailers up in towards your higher time frame key level. The reason why I was able to hold this, as I mentioned, is because I took some off as it approached your high of day level. The ways you can look to scale, in this case, I scaled around 30% of my position. You can look to scale 25% off at your highs and scale 50 and 25, or you can do 30, 30, 30. There's different ways on how to manage your position. It really depends on the actual setup. How much momentum does the market have? How much continuation does the market have? Based off of that, you can look to manage your position accordingly. As you can see right there on NVIDIA, nice push towards the upside as Qs finally broke outside here as well. I ended up speeding up the tape, but as you can see, it really only went up in a straight line. So that ended up being a really solid trade. We also had a little bit more continuation if I do speed this up all the way back up and towards your 141. So that being said, I hope you guys did enjoy the video. Hope you guys did learn something new. If you did, appreciate if you guys drop me a like and sub, and I'll see you guys next week for a brand new video. Peace.